Is the choppy market action simply profit-taking and rebalancing at the end of another strong year for stocks, or is it sending a more cautious signal about the economy in 2025? Here to take on that question is Mohamed El-Erian. He is Allianz Chief Economic Advisor, and always great to see you. Welcome, Mohamed.
Thank you, Mike.
So here we have, obviously, very strong year for stocks, sure, skewed toward the very largest, and this rise in Treasury yields, which I guess has been perplexing to some. It has really taken flight since the Fed started cutting rates. It doesn't seem specifically about inflation expectations. And the big question is, can the real economy handle it? I mean, that's what stocks care about. What's your read on that element of the market action?
I think the real economy can handle it because rates are going up for one good reason and a couple of less good reasons. The good reason is growth. U.S. continues to outpace the rest of the world. You see that in the rate differential in 10 years between the U.S. and Germany. That's now 220 basis points. That's quite high. There are two issues. I think inflation is more sticky, and the Fed is going to tolerate more sticky inflation. And also there's a concern about issuance. But on balance, the economy will be able to handle this if we don't get a policy mistake.
And what would a policy mistake represent right now? You know, I think a lot of folks were looking for evidence that that might be one of the market's concerns after the Fed really did reduce its anticipated rate cuts for 2025. But you wouldn't necessarily expect to see longer-term yields going up if we were pricing in a potential policy mistake that would bring on recession.
Yeah, and I think the rate behavior has a lot also to do with the notion that inflation may be sticky. I cannot stress how important it is for policy not to undermine U.S. economic exceptionalism. That has acted as a shield for U.S. markets, for the U.S. economy, from a lot of headwinds coming from the rest of the world. Europe is essentially in recession. China cannot balance its reforms with its stimulus. Geopolitics has gotten more complicated. So we've had this incredible shield for the economy, for the markets of this exceptional economic performance. And we need to maintain that. And this is where the policy issue comes in a big way, Mike. What
policies are you really discussing there aside from what the Fed does? I mean, are we talking about what happens under the next Trump administration, whether it's, you know, taxes and tariffs, or do you mostly mean monetary policy?
So at first, I mean monetary policy. It's important for the Fed not to be overly restrictive, and that means it will need to tolerate a slightly higher inflation rate because there's so many structural changes. And then for the incoming administration, there's going to be a race. On the one hand, you have deregulation, you have liberalization, which is going to get turbocharged by a lot of corporate activity and by what I think are significant productivity promises associated with AI and with life sciences. And on the other side of that race is the risk of excessive tariffs and the risk of undermining the labor market. So a lot will depend on this race, and the hope for the markets and the hope for not just the U.S. economy, but the global economy is that that race is going to be won by what are pro-productivity, pro-growth measures.